Together we will watch a lecture by Buffett in which he confesses his 5 biggest stock mistakes. Plus you will learn how to avoid these mistakes that in the worst case cost you your entire fortune. Enjoy the video.
The biggest investment mistakes have been mistakes of omission rather than commission. I mean, you see the mistakes that result from commission, but accounting doesn't pick up the mistakes of omission, and they're the huge ones. And nobody knows about it unless I feel in the mood to confess, which I don't often, but since you asked. I would say the biggest mistake, I've named a couple in the past. I used to always name the Fannie Mae stock we didn't purchase in the early 80s.
Buffett talks about his biggest mistakes as those where he was passive and missed opportunities. As an example here, he points to the US mortgage bank Fannie Mae, which was extremely cheap at $1 to $2 in the 1980s, but then traded for more than $70 in the late 1990s.
Now, I don't count as a mistake not buying Microsoft, for example. I met Bill Gates on July 5th, 1991. He spent about 10 hours explaining Microsoft to me. He did it with an orangutan the next day. He said that was easier. It was fascinating to me. And I knew he was a terrific guy and a terrific manager, and Microsoft was a terrific company. So I went back and bought 100 shares just to keep track of it. But I didn't know enough to make the decision. I really didn't know what other people were doing in the field. And so it was outside of what I call my circle of competence. And the important thing in investing is not how big your circle is, it's knowing where the perimeter is so that you stay within the circle. And we try to do that. Now, Fannie Mae was in my circle of competence in the early 1980s. So when I miss something like that, I deserve a thumb-sucking award, basically. If I miss, all kinds of other things, that doesn't really make any difference. But I missed that one. That costs billions of dollars, never shows up in our financial statements.
In his Fannie Mae mistake, Buffett did nothing despite the fact that he himself says that Fannie Mae was in his circle of competence. It is important to mention what many people misunderstand about Warren Buffett. When Buffett speaks of only buying companies he understands, he doesn't mean just understanding the business model. Because Buffett of course knows that Microsoft sells operating systems and office solutions. But what Buffett means by understanding is being able to forecast future profits reasonably well, because that is crucial for the long-term direction of the share price. And that's extremely difficult with technology companies because there's an enormous amount of innovation there. That means Buffett understands the business model of tech companies very well. He just doesn't dare to forecast the future profits reliably. Because, for example, as a result of innovation, the competition can grab away market shares or entire markets, making profits completely unpredictable. In the case of the Coca-Cola stock that Buffett owns, he's very sure that people will still be buying Coca-Cola bottles in 10 or 20 years. And also with Apple, he has been quite sure that once people have an iPhone, they won't want anything else, and that gives a certain planning security for many, many years.
An example I use more often now, more recent, this is even worse. I set out to buy 100 million shares of Walmart about 5 or 6 years ago. It was at $23 a share, so it would have cost us $2.3 billion if we bought it. If we had bought it, it would be worth about 11.5 or 12 billion. Now, I knew enough to understand Walmart. I mean, I knew it was the retailing machine of all time. And what happened on that was I bought a few million shares, and then it went up. It probably went up to 23 1/8. Now, when a stock goes from 23 to 23 1/8, I mean, that's a major event around Berkshire. I mean, I have trouble adjusting. I mean, my license plate says thrifty, and the guy who designed it knew what he was saying. And so, like a dope, I just said, well, I'll wait till it gets back to where I was buying. And of course, I missed out on 8 or 9 billion. So that's a mistake. But those are the mistakes you don't see.
At Walmart, it's a little bit different than at Fannie Mae. Because at the largest retailer in the world, Buffett had actually already bought shares. But he was then too stingy to buy again for a few cents more and missed a huge run in the stock, which never came back down to the low level of $23. That means even if a stock gets a little more expensive and the conviction is still there, you should keep buying. Of course, if Walmart jumps from 23 to 35 or 40 in one day, I personally wouldn't buy in either. But if a stock moves from 23 to 24 or $25, then there is no reason to miss this opportunity. Before that, of course, you should have done your homework and understand the company behind the stock. Then the price has to be right. In other words, there has to be a safety margin to the downside, and as Buffett always preaches, there should be a strong moat.
Mistakes that you can see is Berkshire Hathaway, literally, today, is a merger of 3 companies in my business lifetime. There was the original Berkshire Hathaway, which we bought into in 1965, or bought control of in early 1965. And then there were two other companies called Blue Chip Stamps, a trading stamp company in California, and Diversified Retailing, a company that started out with a department store in Baltimore. Diversified and Blue Chip got merged into Berkshire, so that's where it all comes from. All three of those were mistakes. Starting with the textile business, Berkshire was a textile company with $20 million in net worth. The whole $20 million was tied up in the textile business, and it was a lousy business. I bought it because it was cheap, not because it was good, and that's a mistake. It took me a long time to get over that. I learned under a fellow who was a magnificent human being, magnificent teacher, and did all kinds of things for me. He put the emphasis on buying things that were quantitatively cheap. That was the background from the 30s and 40s. I call it the used cigar butt approach to investing. I mean, you go around, you walk down the street, and you see a cigar butt, and it's kind of soggy and disgusting and repels you, but it's free. And there may be one puff left in it. So you think, what can I lose? So you pick it up and you see, and maybe there's one puff in it, but it didn't cost you anything, so if it isn't, all you've had is a soggy cigar butt in your mouth. And that was Berkshire Hathaway back in 1965. It was the wrong kind of business to buy. It had actually lost significant money over the previous 10 years, but it was very cheap. So I bought in, and then all of a sudden I owned a textile business.
There are many things here that show how Buffett has evolved as an investor over the decades. Because at the beginning of his career, I would say between the 1950s and 70s, Buffett was buying very cheap companies on a regular basis and had a completely different investment approach than today. More specifically, Buffett did two things completely different than he does today. First, he didn't pay as much attention to the long-term competitive advantage of the company. What was important was that the company was cheap in terms of price. For example, if Berkshire's textile company costs Buffett $10 million, then the textile machines, the buildings and all the land, the entire assets in the company should be priced at around $15 or $20 million. Then the company would be considered cheap, because you got 20 million for 10, or in other words, you got $1 for just 50 cents. The second thing he did differently at that time, especially with the textile company Berkshire, he didn't pay attention to the profits of the company, and the textile business was losing money for 10 years already, meaning the negative trend was already visible for a long time. If earnings had continued to come in despite of the negative trend, things would have been different. But a company that makes losses year after year will eventually go bust. And as Buffett says, there is no last cigar puff, which means selling at a higher price than you bought before.
A New England textile business. A New England textile business in New Bedford, Mass, where about 100 textile companies had gone out of business, and we were the last ones really foolish enough to be trying to make a profit. So it was a terrible base to build what has become Berkshire Hathaway on. I mean, we sat with that 20 million, which was originally 100% of our capital. We sat with that for about 20 years trying to make it work, and it never worked. So if I'd done the things that subsequently we did in insurance and See's Candy and all kinds of other businesses, and done it from scratch and not put them in Berkshire, maybe Gates would have to move over.
Yeah, what people forget, even if Buffett doesn't lose money over 20 years in numbers, because let's say the stock price stays at the same level the whole time, he still has opportunity cost. Meaning if he hadn't put the money into Berkshire for 20 years, but had secured more shares into See's Candies or his later insurance company Geico in exchange, then he probably would have been the richest person in the world at the time of the talk, and not Bill Gates. So I always keep in the back of my mind, what is the investment gonna cost me if there are better alternatives? And with that mindset, you will automatically choose to invest only in the very best opportunities, because everything else is an opportunity cost.
Diversified Retailing, we went into Baltimore, bought a department store in 1966. We thought we were buying a second-class department store at a third-class price. We were buying a fourth-class department store at a third-class price, and that sunk in after a few years, but that was a mistake. Blue Chip Stamps was a trading stamp company, and most of you are too young to remember, but in the 60s, particularly, there was this huge rage, and S&H was a huge company, and Blue Chip was set up in California, and literally it did 120 million of business in 1967 or 8 when we bought it. It now does about $50,000 a year. Under our careful management, lots of effort, we've taken it from 120 million of sales down to about 50,000, and we'll get the rest of the way before long. We bought into a hula hoop, and we didn't know it at the time. So with that great background, all three were mistakes. Put them all together, Three mistakes put together, one each, becomes three mistakes in one pile.
The company Blue Chip Stamps was basically a kind of loyalty program for customers from retail stores. Instead of a card that is swiped at a cash register today, there were stamps that you could stick in books. You could then use the books to get garden furniture, tableware or other items. As Buffett says, the business went from $120 million down to $50,000, mainly because of the change in the technology and more efficient solutions such as electronic cards. And here we see again a business model that became vulnerable to innovation. And this is what should always be looked at. Is the business model of the company I buy protected against innovation? Buffett likes to name the best-selling candy bar in the world here, because nothing has changed in terms of consumer preferences for decades, and it's very likely that nothing will change in terms of consumer preferences for the next 20 or 30 years. Which is the best-selling chocolate bar in the world? What do you think? You are welcome to stop here for a moment before the solution comes and write your guess in the comments. The best-selling candy bar in the world is Snickers.
But we did go into these other businesses. I learned after a point that the real thing in business is to be in good businesses with good people. And that's what works. And it's much more important than trying to buy something cheap, which doesn't, it may work okay occasionally, but it's no way to build a business over time. So those three were mistakes of commission. Even more, the Walmarts and the Fannie Mae's are omission. And we'll have new ones next year. I will have a section in the report this year called The Dumbest Thing I Did This Year. It may take half the report, who knows? But I don't dwell on them in the least. It doesn't make any difference. I've been having fun the whole time, and I'll continue to have fun. And actually, if you played golf and you scored a hole-in-one on every hole, it wouldn't be an interesting game after a while. If it had some magnet in the hole someplace and the ball automatically went to it, you'd give up golf. It's much more fun to play the game, par threes, par fives, occasionally hit one in the rough, and so on. It's a lot of fun, so that's as much as I wish to confess to today.
Yes, we also see Warren Buffett is only human and he also made mistakes. And exactly that gives me as an investor confidence, because not every investment has to be a success. 3 or 4 wonderful investments are enough to become really wealthy. What do you think about Buffett's mistakes and what are your wishes and comments? Feel free to write it in the comments below. Thank you for watching. Ciao.